Going to call the Life Insurance and Financial Planning Committee meeting to order. No need for a roll call. I will just mark everyone's attendance. Good afternoon. I'm South Carolina Representative Carl Anderson, and I will be chairing this meeting today along with my vice chair, Senator Vicki Sawyer from North Carolina. I'd first like to thank AFLAC for sponsoring the networking coffee break that we just had. Thank you very much for your support of NCOIL. We really appreciate it, especially after we just had a lesson on obesity. I felt so guilty until I did not go outside to even get a cookie. I'm going to drink my Sprite for a little energy because I have a flight right after this meeting. But nevertheless, here we are. Need a motion to waive the quorum requirement? Second. All in favor signify by saying aye. Aye. Those who oppose vote nay. The ayes have it, and so it's ordered. Also need a motion to approve the November 16th, 2023 meeting minutes. Motion. Second. All in favor say aye. Aye. Those who oppose vote nay. The ayes have it, and so it's ordered. Before we get started with our agenda, I'd like to note that we're continuing with the new testimony process that we introduced at our last meeting in November. Anyone in attendance who's not scheduled to speak on an issue can fill out a testimony slip stating who they are representing and what their position is on an issue. The testimony slips can be found on the speaker table. After completing the slip, you can submit the slip to one of the staff members, and it will be incorporated into the minutes after the meeting. So what does that mean? That means that if you're not scheduled to talk, you will not talk. You can feel free to submit a slip on any issue. It doesn't necessarily have to be a model law or resolution. We'll start today with a presentation on developments in life insurers' use of wellness programs. Joining us today are Matthew Gibson of John Hancock and Professor Brenda Cood of the University of Georgia. We'll hold questions until both are finished. Mr. Matthew, you want to go first, or are you going to yield to Ms. Brenda?
I will go first since my slides are already visible.
All right, okay, go first. Don't tell us everything.
So again, my name is Matt Gibson. I'm with John Hancock out of Boston. And it may seem kind of funny to, with the slide visual with helping customers live longer, healthier, better lives. And it's like, well, I thought John Hancock was a life insurance company. And I think that's really the key component is who else besides perhaps your immediate circle of friends and your family would want you to live a really long time. Obviously, there is commercial success if we can help customers live a longer, healthier life, but of course, most people want to live longer, healthier lives themselves. So it's that kind of unique opportunity to have that shared value component and really trying to use that as a catalyst for change and longer term health behavior. For those of you who are unfamiliar with what we've done at John Hancock, I will briefly go over what we've done with the John Hancock Vitality Solution, which is our wellness platform that we've integrated into our products. We originally launched it in 2015. We just crossed our 9-year anniversary of launching that just this past Monday. But the real change for us was in 2018, where we made the decision to provide Vitality automatically on every policy that we write out the door. And that's what we did when we introduced Vitality Go. So Vitality Go is included on all policies at no additional cost to consumers. It gives them access to the Vitality platform, the educational materials. some base level benefits really to kind of act as incentives for positive health behavior, including discounts on fresh fruits and vegetables at over 1,400 grocers nationwide. We have a fantastic relationship with the Tufts Friedman School of Nutrition in the Boston area, and provide a lot of that material and information to consumers. And again, that's Vitality Go with no cost. But where it really comes to life at the consumer value level is with Vitality Plus. That does have a charge, just a minor $2 a month charge onto the policy, but that really where we're seeing the strongest engagement within the wellness program itself. You're actually gives consumers access to discounting the premium, as well as kind of a more substantial suite of incentives to drive that health behavior. Most recently with the addition of the GRAILS Gallery Multi-Cancer Early Detection Test, which I'll get into a little bit more detail later for those of you who are unfamiliar with MCEDS. But again, the access to the program itself is completely up to the consumer as to which version they may choose to get, as well as their participation is completely voluntary as far as what areas of the program. Which begs the question of, well, how does it functionally work? Customers earn vitality points, is what we call them, for simple health-related activities that they might be doing to stay or become healthy, like getting their annual screening, walking the dog, going to the gym, getting their teeth cleaned. Those points translate to a vitality status, and then the higher the status, the greater the premium savings that would unlock with Vitality Plus. So think of it not functionally dissimilar to perhaps like a safe driving program that you might see in a car telematic. This is just taking it a little bit of a step further with that there. And we do believe, and I talked about it, that it is functionally working, and I'm excited to share some of the stats here. I'm not going to go over each of them individually, but I want to just really kind of highlight the core message is, we, as a life insurer particularly, enjoy and the privilege of having very, very long relationships with our consumers. So driving this type of health change is really a long-term solution here. I'm not suggesting we've changed mortality in a short period of nine years, but these are often obviously leading indicators that we may be seeing that come to bear. I want to specifically call out the cholesterol, blood pressure, and blood glucose statistics that you see on the screen here, because those are highlighting the specific individuals who had measures that were outside of a healthy range, but then we're able to bring them into a healthy range. That may be through personal medical intervention or actual behavioral change. Of course, we don't have the individual person's information associated with this, but that's there. This also is important to understand that we do have a really high, I like to call it retention rate or stickiness rate as far as participation is concerned. The analogy I tend to use is, don't tell me who's still doing their New Year's resolution in the gym in February. I want to know who's still there in November. And we're really pleased to see that about 70% of our consumers that are using the program either maintain or increase their engagement year over year. And health and wellness does go beyond just simply being physically active and eating well and mental well-being and getting your preventative care. But we did put a pretty intentional focus on early cancer detection. I'm sure everyone here has either a direct or an indirect unfortunate relationship with cancer. 1 in 3 people in the United States will develop cancer in their lifetime. And what's most challenging is that 70% of cancer-related deaths are from cancers we don't look for, we don't find until after the symptomatic. We only really screen regularly for 5. That's colorectal, cervical, breast, prostate, and if you're a smoker, CT scanning. So there's only 5. So that's part of the reason why we brought GRAILS Gallery Test to the platform and providing access to John Hancock Vitality customers to access that. It is a simple blood draw. They get 2 vials of blood taken, and they can actually screen for about 50 different cancers. It's not a risk of cancer. It actually is, we believe you have this cancer currently, to get it early. So their kind of mantra is detecting cancer early when it's treatable. And how consumers actually go through that, we have it through the digital experience, both on the web and on the app, where they learn a little bit more about the test and then can ultimately request the test the test kit is sent to them directly, and they can then facilitate their blood draw through a phlebotomy partner like a Quest Diagnostics. And the results are then provided to the prescribing physician. John Hancock does not receive any of the information. In fact, we don't even know which consumers have opted to take the test or not. We're just really providing access to it. And the big question is, well, what does the results look like? Well, it's very clear if cancer is not detected, it's pretty much in big, bold letters, and if they do believe that there is a cancer signal detected, there are two kind of predicted locations to help guide that customer and their primary care physician for follow-up diagnostic and ultimately treatment within that. When we were bringing Grail and Gallery on, one of the things that we have is obviously a certain duty of care to our consumers. We didn't want just to say, hey, we think you have cancer, good luck with your cancer. We wanted to make sure that there was actually a lot of support on the back end for consumers to do that. So both either needing possibly a primary care referral, getting access or guidance as how to navigate their existing healthcare coverage and what might be needed there. But I'm not going to go through all the specifics here, and I want to just point out that it really is about providing care to consumers. And I will end this with a quick personal anecdote. So last Thanksgiving, my father-in-law was diagnosed with stage 4 melanoma. He was not symptomatic. He had no skin lesions. It manifested in his small intestine and spread to his adrenal gland and liver and other lymph nodes in the surrounding areas. Access to early detection is obviously very critical because he was asymptomatic. There's no reason for him to do that until things started to poke into his thing. We're hoping his outcomes will be positive. We're still kind of undergoing a lot of immunotherapy for the last 18 months, but we are looking forward to hopefully a positive outcome. But I share that because wellness programs and early cancer detection can feel very cerebral, right? It's about this future health improvement that may or may not manifest itself. But it's those micro moments that we're really trying to bring forward to facilitate that type of change. So again, thank you very much.
Let me start by saying thank you. I am Brenda Cood. I'm very happy to be back in my native state of Tennessee. And as someone who lives in Athens, Georgia, and wouldn't dare wear this jacket in town, thank you very much for the opportunity to wear Tennessee orange again. I think we can all agree, and I've certainly heard conversation today, that improving our health matters to all of us. I don't know anything more about Matt's program than you heard today, but what I did was take some time to think about some of the questions that I think we should be asking about programs like his. And I will, in full disclosure, say I participate in a health insurance wellness benefit that's similar to this. So my questions all relate to the cost versus the benefits, accessibility of the activities, as well as the benefits of the programs, protection of personal information, is there relevant regulation, and finally, how this impacts the proportion of our society who have a mind of its own. There we go. So first of all, I did some research. I am a researcher, so I looked online to see what I could learn about anything we know from previous wellness type programs. And there's an excellent report from RAND that looked at workplace wellness programs. And it makes Matt's program sound like a superstar because in general, this analysis indicates that at best there's only modest benefits from workplace wellness programs. For example, they cite no significant reduction in the cost or use of ERs or hospitals, no significant reduction in cholesterol. The average weight loss is 1 pound a year over 3 years. So nothing stellar in terms of the results of these programs based on their analysis. And I think they're asking the right kinds of questions in this. And one of the points that they make, I think, is that motivation matters more than the program. So I think about my friend who has access to the same health insurance wellness benefit that I do. For me, it's a matter of which gym do I go to. She's not going to the gym. It doesn't matter that that's one of the benefits available to her. So I'd like to see for programs like this, some very careful short-term as well as long-term analysis of the cost and the benefits. I'd also like to hear more about the accessibility of the types of activities in the programs as well as the benefits to everyone. So I grew up about 50 miles from here in a farming community where the only McDonald's was the local funeral home. They do actually have a restaurant there now. But are these activities and are these benefits as accessible to the folks in my community as they are to someone who lives in Boston? And you could ask the very same questions about certain urban areas where they don't have any additional access beyond what individuals in my farming community might have. Also, I think about how those with physical limitations can participate, for example, in activity-based programs. And I think another question is, what about mental health? We've heard a lot about mental health today, and I know there are some mental health benefits, but what are those? What are those, and how are they accessible, and are they what the benefits that people actually need? Thinking about protection of personal information should be something that comes to mind right away, of course. Probably everybody here is affected by the AT&T data breach, and I know I've gotten multiple emails already about that. And we're all just getting numb, right? Every week there's something that's happening. But if there's a data breach about my personal health information, changing my username and my password is not going to fix that, right? I can't change my personal health information. So I would have questions about how this information that's being accessed is being collected, stored, used, and that, somebody fix this. And the euphemism shared, which means sold. So what's happening to personal information that's being collected here? And you talked about, not getting in between the cancer detection and the patient, but you have other information that's being accessed as a part of this program. And this is not specific to you, Matt, and I'm not looking at you because I expect you to answer the question. I'm just saying these are important questions that we should be asking about any program, because what I don't have up here is that, to the best of my knowledge, these programs aren't regulated. So there are regulations that apply to workplace wellness programs, but I couldn't find any indication of how an insurance-based program is regulated. So who holds the insurer responsible if data aren't protected in the way that they should? Another question I would have is about how these types of programs might change underwriting. Is the underwriting somehow designed to screen out the less motivated individual? Are there cross-subsidies in the pricing of products that mean that those of us who choose not to participate in this type of program are actually paying for the program that offers these types of wellness benefits? And then the final point that I want to make is that I also care about increasing the proportion of our population who have access to life insurance and who have life insurance. A theme this year at NEIC is minding the gap, and one of those gaps is folks who don't have life insurance. The committee that was mentioned earlier today heard a presentation last month about individuals who have served their prison sentences but can't buy life insurance. The Federal Financial Literacy and Education Commission that met just this past week also talked about that topic. This is Financial Literacy Month, but it's also National Second Chance Month. So giving people who've served that prison sentence and have cannot buy life insurance from most insurance companies is a topic that people are talking about. I can't answer any questions about that. I just know that it's, an example of ways that we all could be working together to increase the proportion of our population who have life insurance. So again, thank you for the opportunity to be here.
Many thanks to both of you. I'll now open the conversation up to legislators. Does anyone have any questions or comments? All right, Senator.
Thank you, Mr. Chair. My 20 years of being a health insurance and life insurance agent, so many of the times, even in employer-sponsored wellness programs, it's the people who are already trying to be fit or already go to the gym that participate, not really the ones you want to do this. They're like, oh, I was hoping Susan could get involved in this, or I was really hoping when we implemented this, Mary and Tom might participate, but it seldom happens. So I noticed in your slide, and it's Matthew, right? I noticed in your slide that you said 40% of those that participate, 50% of those, 70% of those, great. But of the total people that have a life insurance plan with John Hancock, how many of those people participate in the program?
There we go. So kind of, we're just going to isolate just the period of time in which we offered it, just for point of order, just because I don't have the total number of customers that we have in force on that. So there's two components here that I want to address. So first, we're at roughly about a 66% opt-in for the full version of the program with consumers. And as far as getting started and engagement in the program, it hovers a little over 60%.
Actually, that's far better than the typical. Thank you.
It does, and I, just to add one, I think, point of clarity, I think one of the things, and I may have missed it in my commentary, employer-based programs versus life insurance-based programs, there's obviously the component of time that is a big part of that. I think I saw a stat somewhat recently saying that the average, employee is at an employer for 3 to 5 years before they're leaving. You're not going to see real health improvements or over that short window of a time. And in reality, right, like the 9 years that we've had Vitality up and running at John Hancock, we're really just starting to see that come to bear. We are hoping at our 10 year to do a pretty comprehensive mortality study release.
And I might just mention, my colleague here brought up the point that there is a difference, of course, with people who at an employer who have employer-sponsored health insurance purchased on their behalf than someone who chooses to purchase life insurance. Perhaps a different population. Thank you.
Thank you. Representative Carter.
Thank you, Mr. Chair. First of all, I want to thank you for the program that you're presenting and your presentation. But what I'm looking at is what initiatives do you currently have to have outreach to our populations who are underinsured or uninsured? They need to have a long life as well.
Yeah, so that's one of the key things that we really focus on. We recognize particularly the markets that a lot of the life insurers tend to serve are a little bit more on the higher end of the income window. Tax reasons aside, there's still important protection that is needed for Main Street consumers in that space. So when it came to bringing Vitality, we don't have a face amount requirement as far as gaining access to the program. In fact, we have a more mass market product that provides a slightly different delivery mechanism of the premium savings. It's actually a cash back component versus a policy credit component. But that is specifically designed for the really more mass market, Main Street consumers that aren't getting the coverage, as you mentioned, but also they have still access to the same portfolio of incentives and benefits, including the food benefit and other pieces there. But I do encourage any other insurer that would be looking to do any sort of wellness program roll out to really keep in mind the point that the gentlelady had made about access and not just necessarily discriminating off of face amount or income-based bands.
Thank you. Follow up, Mr. Chair. As an aspiring life insurance producer, I'd like to know if we wanted to download your app, is it available now, and if so, where?
So the Vitality Experience app is available for download, but you wouldn't be able to actually log in without a policy. That actually is in place for a lot of actual privacy component reasons, as she mentioned, because we obviously have an agreement with Vitality to bring that forward. And as far as data not being shared with them, we only share information to Vitality as far as Matt Gibson bought a policy, he now has access to the program, make sure his profile is set up so when he attempts to register it is. Conversely, we don't receive information back from Vitality as far as any sort of health information that's there being provided as well. But we do have a lot of information on the public johnhancock.com website, of course.
No further questions? Before we move on, I'll just note that NCAR does have a Rebate Reform Model Act, which was adopted almost 5 years ago to modernize state anti-rebate statutes and regulations so that they recognize new products being offered by the insurance industry and maintain necessary consumer protections. It may be worth taking a look at the model to see if it needs to be amended at all to recognize the type of programs we've heard about today. If anyone has any questions or comments on that, please reach out to the NCAL staff. Next on the agenda is a presentation on efforts to promote lifetime income. With us here today is Brett and Professor Cood again. We'll hold questions until both are finished. Please go ahead, Mr. Brett.
Thank you very much, Chair Anderson, and to the committee as well for the opportunity to talk about retirement savings and lifetime income today. My name is Brett Hester, and I serve as General Counsel at TIA, where I'm responsible for strategy, policy, and operations. I want to give you just a little bit of a brief background on the Teachers Insurance and Annuity Association of America, TIA. It was founded as a nonprofit in 1918 by Andrew Carnegie to solve the problem of teachers retiring in poverty. We're very much committed to the same mission today of helping those in the education, healthcare, nonprofit, and government sectors retire with financial security and dignity. Over the last 100 years, we've paid over $500 billion in retirement income payments to our participants. So I'm excited. It's a good segue actually from the last panel in terms of talking about how long people are living and making sure that as many people as possible have access to the retirement system. 2024 is actually the 50th anniversary of ERISA, the Employee Retirement Income Security Act, which celebrates its birthday on September 2nd. So it's a good opportunity to reflect on ERISA's successes and what remains to be done. In one sense, ERISA has been a terrific success. It was passed in 1974 it took a long time to get there, following the 1963 failure of the Studebaker and Packard automobile companies, which resulted in the loss of thousands of jobs for employees and also the loss of their pension benefits. It has done a great job of making sure that employees who are covered by retirement plans, that they're managed and protected in accordance with fiduciary standards and safeguarded. On the other hand, as the slide shows, there's still a lot of work to be done. It's astonishing, but there are 55 million American workers who don't have access to a retirement plan through work. And in the 50 years since ERISA passed, there's been another phenomenon that has occurred, which is the decline and near disappearance in the private sector of defined benefit pension plans. In 1975, shortly after ERISA was passed, more than 70% of private sector workers had access to a defined benefit plan and the promise of lifetime income and a paycheck for life that it promised. Today, that number is down to 12% in the private sector, so it's been a significant change. So there's clearly a significant amount of work to be done. We're also in the middle right now of what I've heard called the silver tsunami. 11 to 12,000 people a day are turning 65, which is more than 4 million people a year. And the result of that, when you look at the coverage gap and the income gap, is that there's a projected $4 trillion savings gap in the retirement system, and it's projected that as many 40% of American families will retire without enough savings to last them throughout their retirement. But the good news is that there is actually we've been calling it a retirement crisis, but I want to reframe it as a relatively easily solvable retirement challenge, because there are steps that we can take to address this problem. There are really four basic principles. First, the important thing is to make sure that as many employees as possible have access to a retirement plan at work. A key here is auto-enrollment. There's also a really promising development for people who don't have access to an employer plan, which is roughly 19 states have enacted or in the process of implementing so-called state-facilitated retirement plans, or auto IRA programs. And there are a couple of more states that are in train of doing that this year. Washington State, for example, just updated a more robust version of theirs and enacted new legislation, I believe, either last week or the preceding week. So those are very promising. The statistics show that people who have access to a workplace retirement plan are 15 times more likely to save for retirement than people who don't have access to a plan at work. There's also another step that we can take is to make sure that people are saving enough money, and that needs to be in the 12 to 15% range, and obviously even higher can be better. One step that has proven very promising is automatically escalating employees' contributions, so that it starts at something like 3% and then steps up gradually 1% or a couple of percent a year until they're getting to that desired level of savings. So that's another promising step that we can take. Third, it's really crucial for retirement plan menus to include in-plan lifetime income solutions. Making these options, and it's important to emphasize that they can be options, available through plans lowers the cost of these valuable solutions and helps workers gain access to them and information about them. And that's a good segue to the fourth principle that we can follow, which is providing adequate education and advice to workers about the options available to them, about the consequences of their decisions in terms of enrolling and how much they save. At the state level, in terms of state and public plans, there are also things that members of this committee and other policymakers can do. First, you can ask the simple question: do our laws provide language and direction to ensure appropriate contribution levels and lifetime income options? Do hybrid plans and supplemental and core defined contributions plans, do they have enough lifetime income options embedded in them to help people not only ensure that they have enough savings, but can also convert that into a guaranteed stream of income that they won't outlive? And this may be particularly important in states that don't participate in Social Security for public workers. So the culmination of all of this is that last year, and it followed the adoption by Congress of its second secure major, it's called Secure 2.0, following Secure 1.0, which was passed in 2019, major comprehensive retirement bills that still leave work to do, is we introduced what we're calling, pretty simply, a retirement bill of rights. I don't think there's really anything in here that's particularly complicated or controversial. The first premise is that if you work a full career, you should have the right to a financially secure retirement. And I want to emphasize, it's not an entitlement, it's just making the tools available to workers to allow them to do that. The second principle is that every worker should have access to low-cost investment options that help them generate sufficient savings and ample income for a dignified retirement. The third principle is that every worker deserves clear information to allow them to compare savings and income options and make informed choices to achieve a secure retirement. And finally, it's not really a right, but it's a principle, is that it's a shared responsibility of workers themselves to enroll in their plans to save enough, of the private sector to make plans available to their workers that help them do this, and to policymakers to put the right policies in place to allow this to happen. Again, thank you very much for the opportunity to present to the committee today, and look forward to answering your questions after Professor Coote has a chance to speak. Thank you.
Thank you. Do we have any questions?
Just a quick question.
All right.
I liked your presentation. My only problem, in reality, I represent 90,000 people who are barely able to, half of them can't afford pizza on what it's $4.99. There's one night a week at local pizza place. They're $4.99. They are packed that night. So in reality, they do not have the ability to save 12 or 15%, the vast majority of my constituents. In fact, I would have to say that they're spending negative, because I know nationwide our credit cards the use is soaring, and the amount of debt that each one of us is accruing is just multiplying every year. So I don't think, though I would love that to be a possibility of the 12 to 15%, I don't see it as a realistic possibility for anyone who, if you don't have a real savings plan through your employer, which you guys said you're like 15% more or 15 times more likely to save if there is a plan. These people who are late in the game near 65 are just barely getting by, and they're not going to be able to put any of that 12 to 15% away.
That's absolutely right, and I do think it's even valuable though for that initial amount. And we have found that when there is automatic enrollment, that people do actually tend to. It's a hardship, but it's in addition to paying your current self, you have to pay your future self, and it's very important. Understandably, it's very hard for certain people to get to 12 to 15%. But it's also vitally important to start and to build that. It also provides a cushion. So any amount helps. But yes, you're absolutely right.
Thank you.
All right, thank you very much. Now we shall hear from the vice chair of this committee. Oh, you wanted to say, okay.
My turn. Thank you very much. So we share a lot of the same ideas, and I'm not going to repeat, but I want to add a beginning and an ending thought, really, to what he said. So I think, retirement Bill of Rights starts with making sure we have that solid base of Social Security and Medicare. Regardless of what you think of those two programs, that is the basis that most people are planning their retirement on. And we know that Social Security was only ever intended to provide 1/3 of income, so we certainly have to do more than that. But we have to start by keeping that strong. Then we need to make sure people have savings. And the kinds of things that Brett talked about are plans to make sure that happens. It is absolutely critical, if people are going to accumulate wealth in their lifetime, that they have access to workplace plans that include automatic enrollment and payroll deduction. That's how people actually build wealth in the U.S., especially given all the questions about the housing market today. So we know that from research, that's the way those things are happening. And I'm glad that Brett mentioned states that are making that happen through various forms of automatic IRA plans that incorporate this very important concept of automatic enrollment, which you can opt out, and then automatic payroll deduction. And with the auto escalation, that, again, those are key features in helping people accumulate wealth. I'm concerned, though, about two populations. So one is the low-income population, as you mentioned. We've had something called a Savers Income Tax Credit that was supposed to help lower-income individuals save, and it basically hasn't worked. It wasn't well-known. It wasn't well-used. I understand that based on Secure 2.0, there will be something that's a Savers Match that's intended for lower income individuals. So we'll see if that's effective. And I also think this notion of, I've taught financial education for my entire career. So reaching people where they are is so important to start. So with a college student, I would never say save 15% or 10% or 12%. I would say your goal should be to try to save $1,000. If you get $1,000, set a new goal. Then that might be saving 10% of your income, but you have to reach people where they are. Although I always say to my college students, enroll in your retirement savings plan at work the day you're eligible. At the minimum, if that's what you have to do, but begin as soon as you can. The other group that I'm really concerned about is those who are in what's called the contingent or the gig economy. I've seen statistics that no more than 3 in 10 of those folks have a traditional full-time job. So they don't have access to this automatic enrollment, except that both Uber and Lyft are working to make that possible for them. So I've read that both are working to offer payroll deduction IRA. So it's an automatic withdrawal from their their pay to participate in an IRA. There are apps that will automatically sweep an account and put the excess, you define the excess, into an IRA. So those are the kinds of things that we have to think about for people who are not going to have a 9-to-5 job with regular payment. So, and I agree that if we are successful in accumulating significant savings, then a lot of people won't know how to manage that, to make that last for their lifetime. And that is where an annuity comes into play. However, I have two caveats. One is that they know they're choosing an annuity. When I began as a college professor, I put money in TIAA. I don't know if I knew it was an annuity. It would have been better had I known that. And today, onboarding is a website. It's not a person. It's not a session in a room where someone explains what your options are to you. And my second caveat is I want to make sure that those annuities that are offered are basic annuities that are relatively easy to understand and that are low cost, which means they're not the ones being marketed to investors or as a way to avoid taxes. And then finally, I couldn't leave here if I didn't talk about improving financial literacy, because that is the thing I've spent my life doing. And financial literacy also includes attitudes, so personal responsibility. It also includes perceptions. If nobody else is saving, why should I? If everybody else is saving, I should too. So we have had programs to try to change the way people think about saving, to see that it's something that everybody does. Earlier today, we heard that states are doing a better job at encouraging or even mandating financial education in the school system. And if anybody here is from Illinois and wants to claim they were the first to do it, I can help you with that, because Illinois required consumer education in the 1970s, and that was what we now call financial education. But teachers are not prepared to teach it. So if you're in a state where you have the opportunity to influence funding, please do that. They're no more prepared to talk about credit cards and how they work than somebody else might be. So teaching that is pretty intimidating. And I also want to encourage you, if you don't know, to go home and find out if your state has a council on financial literacy where everyone associated with state government is coordinating what they do, or look for something called a Council on Economic Education, which is probably located at a university in your state. And if you want to support and encourage financial literacy, that's a way that you can do that. So, thank you.
Thank you very kindly, and that is great information. Savings has always been a part of my teaching from coming up. So certainly I want to thank you for those words of encouragement for us. Now we will hear from Representative Hefner.
Thank you, Mr. Chairman. Thank you for your presentation. Something just caught me while I was listening to your presentation. When you said your goal is $1,000. In my state, in Oklahoma, we have an ABLE account that we encourage families who have kids with disabilities to put money in, achieving a better life experience. And going around the state, I, as a financial advisor, will help families who have a child to plan for that third retirement. And I have a friend in the disability world that she's a parent, and she's from Eastern Oklahoma, and she said, Ellen, our family has never learned how to save. And you're talking about things that I don't trust. And so we have to take another step back. $1,000 is too much. She taught me a different way to talk to people who have never put a dime or saved and had a savings account. That she says, with her accent, her beautiful accent, she would say it's a gallon of milk and it's a loaf of bread. And so I think we have to take another step back. When we talk, even the words financial literacy, that's not even explaining to people what that is. And so I really, it's not dumbing down. It's a lot of people in our world have never learned to save. And so I appreciate your presentation. But again, I think that we have to talk with people and teach them a little bit more about the saving piece. My mother-in-law, who lived through the Depression, rest in peace, she told me, she goes, you need to save $5 a week, and then one day you'll be a millionaire. And I was like, be quiet, when I was 20. And of course, that's true. But at the time, I didn't know anything about annuities. And that word there too is something that people have to learn to trust. And so again, I appreciate your presentation. This is just an added on insight into a world of families who have high medical costs, high medication costs, and they're counting on Social Security and Medicaid to take care of their kids who have benefits that leave them in poverty, and trying to save $5, or people that have disabilities that I talk to who want to save money, and we talk about maybe we don't have a pizza this week, and we can put that money in your ABLE account. So again, all those experiences, we have to listen to their stories and find them where we can support them. Sorry I went so long. Thank you for your time.
And let me just say quickly, I said you have to meet people where they are. So for my college students, $1,000 is attainable. But I grew up in a farming family. I remember the day my dad came home and said the bank's offering something called a CD. That sounds really risky to me. So I've spent a career teaching, so I would never walk into a room and assume $1,000 is attainable for any audience unless I know who that audience is.
For follow-up?
Go ahead.
Yes, it was nothing, it was just more information for everyone, because that $1,000 just hit me. I was like, okay, we've got to just give a little bit more experience, because I'm sure there's some students in your class that wouldn't have told you they didn't know how to save, and that $1,000 was too much. Thank you.
All right, thank y'all very much. Very fruitful information. Now we shall hear from the Vice Chair of this committee, Senator Vicky Sawyer from North Carolina.
Thank you, Chairman Anderson, my brother to the south,
you
North
go.
Carolina and in South Carolina. So next we're going to move to the part of the agenda is the consideration of the readoption of model laws. Per INCOIL bylaws, all model laws must be readopted every 5 years or else they will sunset. The models up for readoption are on the app and website and appear in your binders starting on page 135. The model acts are the Model Unclaimed Life Insurance Benefits Act and the Life Settlements Model Act. So we're going to handle these separately, as there have been some amendments proposed to the Life Settlements Model Act. So for the Model Unclaimed Life Insurance Benefits Act, it has proven to be a very successful model, and it will be adopted in over 30 states. Are there any questions or comments on the model? Hearing none, I'll entertain a motion to readopt that model, and then a second, and then a voice vote. Do I have a motion?
So move.
Thank you. Chairman so moves. A second? Yes, second from President Tom. Then a voice vote, so we'll say, all in favor say aye.
Aye.
Then a model adoption has been approved. All right, moving on to the fun one. Moving to the Life Settlements Model Act has also been proven to be a very successful model, with it being adopted in about 15 states, with about another 10 states having adopted a combination of the INCOIL and NAIC model. Amendments to the model have been proposed for discussion by the Life Insurance Settlements Association. So we won't be voting on the amendments today. They have been offered up only for discussion purposes, and there is no sponsor attached. With us here today to briefly summarize the proposed amendments is Alan Berger of Coventry. On behalf of the Life Insurance Settlements Association, Alan, would you please go ahead as you come up?
Mr. Chairman and Madam Vice Chairman, thank you. It's a privilege to be here today, and I want to thank the NCOIL in general and the staff. It's late in the day.
Yes.
I imagine everybody's tired, so I will be brief, or at least I will give it my best effort. Signal me if I'm not succeeding. I'm here representing the Trade Association, which is the Life Insurance Settlement Association, and it represents all licensees, both brokers and providers, which is what Coventry, my company, is. And at the risk of being somewhat presumptuous, I don't recognize very many of you from the time a very controversial model was created. And so I'll just say this in the event a couple of you aren't familiar with life settlements. A life settlement, very simply, is the purchase of an existing life insurance policy when the policy owner no longer needs or can afford that policy. That makes up approximately 20% of individuals, insureds, age 65 and older, and literally hundreds of billions of dollars of insurance lapsed or surrendered by that demographic every year. So a life settlement is simply an option, a consumer choice. It was controversial when it began. It was an outgrowth of the viatical settlement business, which had its problems. The life settlement business is meant to give consumers a choice. So, on behalf of Lisa, we appreciate NQIL accepting suggestions. We reached out to Lisa or to NQIL and said we thought that 17 years was long enough and there was a need for some changes. I agree the model has been successful. In fact, the insurance departments and I think legislators have rarely see complaints about our industry. But there are some issues, and 17 years is long enough. I think some of them should be addressed. They fall into two categories. Basically, what I'll call electronic. We live in a different world. Electronic signatures should be accepted. It's inexcusable, and I don't mean to be pejorative, but that some carriers don't accept, willfully don't accept electronic signatures and make it difficult to get a transaction completed. And that's unfair to the consumer. It can take 30, 60, 90 days. And so some of the amendments we're suggesting are meant to help the consumer with respect to getting a transaction completed. Additionally, we have made a suggestion, and these suggestions came from all of the members of the trade association. They were asked, what do you see as issues? And these are issues that they're confronted with every day in terms of signatures, verification of coverage that's necessary. We should be able to get that electronically, not by snail mail and not sent and sent where it's authorized to be sent. So they're, I'll call them housekeeping, efficiency type changes. The other change that many members suggested we come to you with have to do with should agents be prohibited from saying to a client who comes to the agent, I'm thinking of dropping my insurance. Should the agent be prohibited from saying, well, you know, you have another option? You could see if there's value in excess of what the insurance company will give you in the way of a life settlement. Right now, and it's a minority of companies, it's probably no more than a dozen, prohibit their agents from even doing that, from even suggesting that there is this option. That's anti-consumer, and I think we can do better. I recognize that the ACLI would prefer to leave what has been successful left alone. We worked very hard with the ACLI 17 years ago. It was controversial then because of stranger-owned life insurance, which is not an issue today. We should be able to, we embrace the idea of working with you as legislators and members of NQIL and with the ACLI and any other stakeholders to see if we can find ways to improve what's already a good model and make it more responsive to consumers. So with that, I thank you for listening to me.
Thank you, sir, Mr. Allen. Now we will hear from Ms. Jill of the American Council of Life Insurers.
Thank you very much, Mr. Chair. And I promise to be very brief because I realize that I'm standing between this meeting and happy hour. But just very briefly, ACLI does oppose the reopening and amendment of this model at this time. For the reasons stated, we don't see any evidence of consumer harm in the marketplace. And, you know, I don't know how many of you were around when this was negotiated, but it was a period of 2 years and many hours. And all stakeholders, parties participated in those negotiations, insurers, insurance agents, consumers, as well as the life settlement industry. Some of the changes being proposed and not, of course, the electronic information, I don't think that's controversial, nor do I think it's prohibited. The timeframes and then the notice of secondary market options were heavily negotiated at that time and decided when the NCOIL, as well as the NAIC Viatical Settlements Model Act, were adopted. And again, without evidence to harm to consumers in the marketplace, we do not support renegotiating this model at this time. And, you know, I'm happy to answer questions, but really, just to respond to the prohibition on mentioning life settlements, that not only would apply to independent agents who do represent a number of insurance companies, but also to captive agents who are basically they're employees of one specific insurance company. And I don't think anybody would agree that those individuals should be obligated to advertise a product that is in competition to, for example, the options available under a life policy such as accelerated death benefits, et cetera. So again, thank you for your time, and I'm happy to take questions.
Wow, thank you very much. Thank you both. Are there any questions or comments on the proposed amendments? Hearing none, everybody must be agreed with you, Ms. Jill. You were standing between them and happy hour. Since there are some proposed amendments to the model that I believe warrant at least some further discussion, I will entertain a motion to readopt the model until our next meeting in July rather than for the full 5 years. Do I hear a motion? All right. So moved, Mr. Chairman, Mr. President. Do I get a second? Second. All right. All in favor say aye. Aye. Those who oppose the vote nay. Do we have any further business? Meeting stands adjourned.